Hello, I'm Greg Hunter. Thank you for joining us again here on USAWatchdog.com. Back with us is Karl Denninger. He's an analyst and a trader with the very popular website market-ticker.org. Karl, good to have you here.
Thanks for having me back on.
Well, let's talk about this testimony yesterday by Ben Bernanke. And, you know, I feel like I'm in an alternate universe. I read the Bloomberg stories. I watch some of the testimony. He looks like he's sweating bullets. That, you know, Elizabeth Warren is going at him. Senator Corker's going at him. Elizabeth Warren's the new senator from Massachusetts. I mean, everybody is wanting a piece of his hide. And if you watch the CNBC or Bloomberg, oh, it's wonderful. It's good. No inflation. He did a good job. He looks in control. And you say?
Well, Senator Corker has it figured out, and he asked some questions that he couldn't get answers to, and so Elizabeth Warren, of course, has her own set of concerns, which are not necessarily aligned with where I think things need to go. In that, she's got the right idea in terms of the too big to fails. The answer to this problem is not more socialism.
Well, let's talk about Senator Corker and the mess that the Fed balance sheet is in, and the $3.1 trillion on their balance sheet now. Nobody seems concerned that we'll have $85 billion printed to infinity. There's no – how do they get out of this? I mean, how did they get out of this?
Yeah, that's where the problem comes from, and this is what Corker was pointing to, is that what Bernanke has done is essentially blown up asset valuations in certain very limited areas, particularly in the stock market, which is very responsive to this kind of free money, let's pass it all around kind of mentality. The problem with what has happened now, though, is that if you remember back from 2007, 2008, Bernanke's rallying cry, and those on the Hill who supported him strongly, including when he was up for recertification for another term, was that we have an expert here on the Great Depression and on Japan's crisis dating back to the 1980s. We would neither have a depression nor would we go into the Japanese scenario where they had essentially zero growth, very low interest rates, and a flat to deflationary environment for 3 decades. And oh, by the way, a stock market that today is trading at 25% of where it was before all of this happened. So this was the premise that we were all sold. Now, the truth is that what Bernanke has done is put himself exactly in the same box that the Bank of Japan did. Because by taking all of these securities onto his balance sheet, what he's done to himself is that if interest rates start to rise, and with him paying excess reserves, he's going to have to increase the rate at which he pays on excess reserves, or the banks will immediately withdraw that money and go put it into the economy where they can earn something from it. What we have to understand here is that the Federal Reserve for all banks, they must deposit a certain amount of reserves, which are at Bernanke's discretion, to back as capital to back all the loans that they have out on their balance sheet. There is a large amount of money that is currently parked at the Federal Reserve, which was used to generate quantitative easing, to buy all those bonds. Instead of the banks taking that money and lending it into the economy, they can't find risks that are reasonably priced compared to the interest rates that are currently charged in the economy because Bernanke's been suppressing rates. So if you can't loan to somebody at 2% with a reasonable belief you'll get paid back, but that's all you can charge because of the ultra-low environment, then if Bernanke comes along and says, well, I will give you 0.25% or 0.5% to leave this money on deposit at the Fed, it's to your advantage to do that because you don't have to take any risk. You know you'll get it back if you ever go ask him for it. So there's a large amount of money that's parked at the Fed that actually belongs to the banks at this point because they gave Bernanke these treasuries in exchange for that cash. But they're not required to leave it there. Bernanke's means of making them do it is to pay interest on those excess amounts.
And this is where it's getting sticky.
This is where the problem comes from, because if rates begin to rise, then banks will be able to find loans that they can make at a more advantageous rate than leaving those funds parked. And if they take those funds out and put them into the economy, the inflationary impact is immediate. So the only way to stop it is for Bernanke to do one or two things. He can either sell securities in order to come up with the money to pay higher interest rates on those excess reserves. But if he sells treasuries, he makes the price go down and the rates go up, which is exactly the opposite of what he wants. Okay, Or the alternative is he can raise the required reserve ratio and say, you must hold additional funds. But that hits the leverage ratios of the banks immediately, which makes them less profitable. And we already know that they're actually not making any money right now without this $80 billion a year subsidy. So we have a problem here because this is a positive feedback system. Once you start to see the economy accelerate, if it does, and rates begin to rise, the mark-to-market losses on the Fed's balance sheet begin to accumulate. And there was a report out in Bloomberg that said that this amount could be about $500 billion. Well, that's an unbelievable amount of money. But that's about what I came up with 2-3 years ago when he started this. I said, look, this guy could lose $500 billion doing this stuff. And that was just from the back of the envelope. They actually went through the composition. And, of course, as what's on his balance sheet changes, the exposure changes to some degree. But the problem with this is that, a mark-to-market loss doesn't get crystallized. You don't have to recognize it if you're the Fed. It's not like any other company. You can say, well, we're going to hold those to maturity so there really isn't a loss. That works as long as you don't have to sell. But what happens when you have to sell to raise money to pay the interest on the excess reserves?
And he sold all the short-term treasuries in Operation Twist, so he really doesn't have any cash, is what you're saying. He's got to sell the long stuff now if he wants to hold it, and that will drive up interest rates, will it not?
If you look at the Federal Reserve's latest balance sheet, you will see that the Federal Reserve currently holds zero in Treasury bills. Treasury bills are essentially interest rate insensitive. If you hold a 4-week Treasury bill, even though it doesn't earn anything, it's essentially zero interest rate. If rates were to rise, you would have a mark-to-market loss, but you don't have to recognize it because you can just wait 4 weeks and cash it. Okay? There's the same thing with the 13, 26-week bills. You can just wait the 13 or the 26 weeks and cash them in at par. So there's very little incentive for you to recognize a mark-to-market loss. The interest rate sensitivity is very low. Everything else that he has a great deal of interest rate sensitivity, especially mortgage-backed securities, many of which have maturities in the 7 to 10, even 30-year range.
And if he starts selling this stuff, and here's where the rubber meets the road. So, Mr. Bernanke, you want to keep this cash in the banks, and you need to pay them a certain interest rates to do so. Where are you going to get the money to pay the interest rates is what it comes down to. And you're saying he didn't have any short-term treasuries, and all he's got is longer-term stuff. And if he starts selling this stuff, boom, interest rates go up, the economy collapses.
Yeah,
right?
and the only other alternative that he would have would be to raise required reserves, effectively impounding the funds. But if he does that, he collapses the earnings capacity of the banks.
So we're going to have some kind of market event because of this year probably, right?
Timing's always very difficult, but the risks, the larger the balance sheet gets and the longer this game goes on, the greater the risks. And the triggering event probably doesn't come from inside the United States. We now have Italy that's, having all kinds of political problems, right? Well, if you have a major market dislocation that comes out of Europe or Japan, for example, then you've got a problem here because you have a flow of funds out of the United States. If that flow comes out in order to meet margin calls and operating requirements, and it happens to come out of the Treasury and agency markets, rates will begin to rise. And once this process begins, it's very hard to arrest.
And so as rates rise, we have all these interest rate swaps. We have all these 0% car loans that, 45%. I mean, even my area, probably yours too, 0% down, 0% interest rates. You can just fog this mirror and we'll give you a car. That goes away, right?
Yeah, and remember, with swaps, somebody's on the losing end, but you frequently don't know who it is until they get in capital trouble and they blow up. So, it's entirely possible that many of these institutions have taken some of this risk off their balance sheet through the use of swaps. But the problem is somebody has that risk. It didn't disappear. And when they're unable to pay, then it all of a sudden shows up again. I mean, this is the paradox that we had happen with both Bear Stearns and Lehman Brothers. And if this starts to reassert itself in the market, all of this interconnectedness becomes a problem again. And so far, we haven't seen anybody deal with the capital buffer issue in that when you are buying these securities, at historical low interest rates, the only way you can avoid capital losses is never to sell them, because and then you're taking an interest rate loss, because if inflation is 4% and you're making 2%, you're losing 2% a year.
So it looks to me that we're going to have lots of pressure on higher interest rates, that the low interest rate environment that the Fed would love to see go on forever it could unwind soon or this year, is what you're saying.
Maybe. The only way Bernanke wins his bet on not getting trapped by this is if we're Japan.
And that means?
Well, that means no economic growth,
no recovery.
No recovery, very low, probably even negative inflation, in other words, deflation. The job market fails to recover. It hasn't come off the bottom in terms of employment participation ratio since 2009. It would continue to fail to do that. The common man gets destroyed because he has no earnings capacity. All right. Credit availability is great if you have good credit, but nobody wants to borrow, so there's no credit demand either. And the only thing that holds this whole ball of string together is the federal government running deficits. Well, we've got this little problem right now, the sequester, and yeah. So you take any of these straws out of the pile, and you end up with a very bad outcome.
And the bad outcome would, in your description, would be?
Well, the most likely thing that would initiate this would be a severe decline in the equity markets.
Stock market sell-off.
Big stock sell-off caused by some exogenous event outside the United States. That's the triggering factor that I have expected would set off the next set of this. That would, in the short term, appear to be okay from a standpoint of the Fed, because people would go into bonds, which would tend to hold rates down. The nightmare scenario is that we get down into that area and then rates start to ratchet higher as people are trying to cover margin calls by getting out of some of these positions. And if that sort of thing takes hold, now we're right back into the same thing, except now the capital base that was in the equity markets has been destroyed, and so we don't have that buffering factor.
We're talking about another market meltdown on the way, aren't we?
The probability continues to go up. And unfortunately, what Bernanke is doing with the balance sheet is that the larger it gets, the more powder he's piling into the brick house. All right. So, instead of a firecracker, he's got a great big bomb in there now.
$3 trillion.
Yeah. And if it goes off.
All right. The last thing I want to bring up, the last time you were on, you said, hey, the U.S. is going to get downgraded. And, well, we haven't gotten downgraded yet. I mean, they're suing S&P. A lot of people, including you, say they're doing that as a warning shot to don't you downgrade us. But the UK just got downgraded. That's our biggest financial and military ally. Doesn't that mean we're next?
Probably, but you have to realize that the UK is an absolute fiscal basket case, and their numbers look far worse than ours, and they don't have an answer to the problem. And the reason they got downgraded, as far as I can tell from the analysis that I've read on it, is that they basically said, oh, the hell with the inflation targeting. Okay? Then we're going to try to get out of the box that way. And they're not as good at hiding it as we are. We claim that there's no inflation. Inflation is 1% or 1.5%. Yeah. But you see the reality in things in the sub-indices within the CPI report, where health insurance, for example, is up almost 9% over the last year. And you have insurance companies that have filed for 100% increases on a lot of plans going into 2014. So, and then, of course, the laughable claim that health insurance is 0.6% of the average family's budget.
Yeah, I know. Right, we have a 1.5 or 2% inflation, and, that's another thing Bernanke said. Inflation was subdued. When I saw that, I thought, are you looking at fuel prices? Are you not looking at food prices? Inflation is subdued?
Well, it's subdued if you didn't notice that eggs have doubled and gasoline's gone from $2 to $4 in the last, 4 years. And in those situations, inflation's subdued.
Okay,
and you don't ever need to go see the doctor either.
Final question, just to wrap this all up. Do you think we have an inflation? A interest rate event? That's what it looks like. Is we're going to have a spike in interest rates. That's where the bomb blows off, when they have to start buying paying the banks more interest rates, or if Italy cashes in their treasuries, or whoever decides to start cashing in treasuries to meet margin calls, that's where we have, and it looks to me like an inflation, like a interest rate event. Is that what you're saying that's coming?
I think that's the most probable outcome, but it wouldn't surprise me if what we got from a collapse or some kind of event that initiates either in Japan or in Europe is what appears to be interest rate positive for us. In other words, drives rates down. And the reason is that the likely first manifestation of this would be a very severe decline in the stock market.
At least temporarily.
Temporarily, yeah. I would not be at all surprised to see a 20-25% sell-off in this over the space of a couple of months, if not more, if we were to have some kind of triggering event come out of Europe.
And then interest rates would go down temporarily. And then,
yeah, because that's what typically happens is people will try to express their preference for, hey, where do I park all this cash as I'm liquidating my portfolio on a temporary basis? And the answer is they go into treasuries.
Karl Denninger, market-ticker.org. Thanks for straightening us out on this Bernanke testimony and the big danger for some sort of interest rate event coming up maybe this year. Thanks so much for being on USAWatchdog.com.
Ought to be fun. Thanks.